everyone, and thank you for joining us here at Tower Point Wealth. We are certainly very excited to be hosting this evening our first annual Alternative Investments Forum. So we recently hired a new marketing specialist by the name of Luis Barrera, and that was one heck of an intro. So we appreciate that, Luis, and are excited to begin the evening. So in a moment, I am going to introduce Nathan Billigmeyer, who is a Tower Point Wealth's Director of Research and Analytics. And Nathan is going to speak about what alternatives are and why they might make sense in a properly diversified portfolio, especially with everything that's going on in the world, in the markets, in the economy and politics. And needless to say, things are very unsettled, and we think this should be educational for everyone. Now, with all that being said, we also live in a bit of a fragmented and somewhat half-broken airline industry here in the U.S., and that has caused us the need to pivot to conducting this event virtually via Zoom. We're fortunate and happy we're able to, but with that being said, I thought I'd start the event just with a couple quick jokes about air travel. What is the difference between God and an airline pilot? God doesn't think he's an airline pilot. It's a little odd here in Zoom, but I would imagine if I was live, the audience would be roaring right now. When Chuck Norris goes through airport security, he makes them take their shoes off. Got a kick out of that one. And finally, what do you call an unruly, unreasonable passenger at Las Vegas International Airport? A McCarran. Not bad, right? Needless to say, we're excited, and we also are dealing with extremely unsettled times, both economically and politically, and obviously investment-wise as well. And I simply wanted to briefly highlight Tower Point Wealth's commitment to education, and hence this forum. So our overachieving goal here at the firm is to help you remove the hassle of properly coordinating all of your financial affairs so you can live a happier life and enjoy retirement ultimately. And one of the primary ways that we seek to deepen the relationships and the partnerships that we have with our clients, close colleagues, and friends is through continual education. So sit back, perhaps pour yourself a drink, and enjoy tonight's Alternative Investments Forum. Nate, you're up.
Thank you, Joe. The Chuck Norris joke. I love a good Chuck Norris joke.
Not bad.
Hello, everyone. My name is Nathan Billigmeyer, and I am Tower Point Wealth's Director of Research and Analytics. It is my pleasure to be moderating tonight's Alternative Investments Forum. I'll cut to the chase. For virtually all investors, 2022 has been a challenging and frustrating year. Persistently high inflation has resulted in an environment of quickly rising interest rates, highlighted by today's decision by the Federal Reserve to increase their Fed funds rate by 0.75%. This has led to a double whammy of twin sell-offs across both stocks and bonds this year. After increasing more than 31% in 2019, 18% in 2020, and 28% last year, the S&P 500, which is an often-cited proxy for the stock market, has declined more than 20% this year. And to make matters worse, the bond market, as measured by the Bloomberg U.S. Aggregate Bond Index, has suffered through declines not experienced in more than 50 years. Put differently, investing in the conventional stock and bond asset classes simply has not worked very well this year. Not surprisingly, these declines have led to an increase in demand for supplemental investment opportunities outside of these traditional asset classes, and have led more and more people to inquire about alternative assets or investments. Simply put, an alternative investment is any financial asset that does not classify as a traditional stock, bond, or cash. While they can vary widely in their accessibility and structure, alternatives can provide an opportunity to boost returns, generate income, provide potential tax benefits, and reduce overall risk in a portfolio. institutions like pension funds and endowments have been utilizing them for years. And today, more and more individual investors are questioning why they have no exposure to alternative investments within their portfolio and whether they should change their investment strategy to include them. So sit tight, as we are fortunate to spotlight 3 experts who will be weighing in on 3 specific alternative investment categories: private equity, private credit, and cryptocurrency. But first, back to Joe for a little housekeeping.
So all participant lines, those attendees tonight, will be muted. We will be doing a question and answer at the end of the kind of the official part of the webinar itself. So if a question does come up, please just simply ask it virtually via the chat function of Zoom, and we will log all of those questions and answer them during our Q&A. Please be sure to adjust your audio settings on your computer or device, and please make sure you toggle the speaker view versus the gallery view just to see what you might like better. We will be putting out a full recording of the entire webinar within the next 48 hours. So please keep your eyes peeled for that. And finally, here at TowerPoint, we are active users of social media. So I encourage everyone to take out their phone, open your favorite social media app. And if you don't already follow TowerPoint Wealth, type TowerPoint Wealth into the search bar and click whatever thumbs up button may pop up to follow us, as we will be disseminating the final version of this webinar via social media. Thank you. And Nate, back to you for introductions.
Thank you, Joe. Let's get this thing going. I first would like to allow each of our expert alternative investment panelists an opportunity to introduce themselves. First up, we have Christian Lena from First Trust. He's our private equity specialist, or an expert. Christian, can you give us a quick minute and a half spiel on who you are, what you do, and
I certainly can. I will be brief. So I am a specialist with First Trust on the alternative investment side in the Western United States, and came to First Trust through a joint venture establishment with Vivaldi Asset Management out of Chicago, Illinois. Deep specialization in alternatives, so ranging from private equity, private credit, real estate, hedge funds, et cetera, et cetera. My background is actually hedge funds and actually professional trading, and have been in the business for 2 decades. So have seen multiple phases to this cycle, and am excited to embark upon this new regime change, because there's lots of opportunities out there, even though people may be a bit fearful.
Thank you, Christian. Next, we have Steve Krull from First Eagle. He is our private credit expert. Steve, tell us a little bit about yourself.
My name is Steve Krull. I work for First Eagle Alternative Credit. We're part of First Eagle Investments, which is based in New York. It's a $120 billion mutual fund complex. We sit on the alternative credit side of the business. We manage about $20 billion in below investment grade alternative credit, both in the public broadly syndicate bank loan market and in the private credit market. I began my career 25 years ago working in the broadly syndicate market, which was much akin to what the private credit market looks like today, as we look back over history. My role at First Eagle Alternative Credit is as a portfolio manager on our alternative credit platform, as well as a head of trading. So I get to see both the public side and the private side, from a debt perspective. So it's certainly an interesting time. I will also echo the comments. Not many things keep us up at night like the stock market does. Really, we're looking for very good investment opportunities in this current market environment, and we think it's a very good time to be looking at alternative credit as a way to insulate your clients' portfolios from the volatility that we're seeing in public markets, both equity and traditional fixed income.
Perfect. Thank you, Steve. Last but not least, we have Augie Diffenderffer from Eaglebrook Advisors, who is our cryptocurrency expert. Augie, tell us about yourself.
Thanks, Nathan, and thanks for having me, guys. I work for Eaglebrook Advisors. We are a technology-driven platform that allows financial advisors to have secure, streamlined, and compliant access for their clients to digital assets. My background is in traditional finance. I worked for some top-tier asset managers for about 15 years prior to making my way over into the crypto space, which had been intriguing me, let's say, for many years. And so I joined Eaglebrook about a year ago, and my goal is to help preach the gospel of crypto to the masses. And in doing so, ultimately help advisors and clients understand how this new emerging asset class can fit within traditional asset allocation mixes and traditional portfolios.
And to testify briefly how much of an expert Augie is in cryptocurrency, Augie, what do you have out front of your residence?
I hang a Bitcoin flag out front of my house.
Well, if that doesn't make you legitimate, I don't know what does. So kudos for obviously keeping it real, let's say.
Thank you. Thank you.
Well, thank you all for taking time out of your Wednesday evening and spending some time with us and our clients and helping us understand what is a very difficult and a new asset, not new necessarily, but new to many individual investors anyways, asset class and why it would make sense in a diversified portfolio. I'm going to start off with really a broad question, and I'm going to throw it out to Steve first, and then we'll go to Augie and then Christian for your thoughts. Why do non-traditional or alternative investment strategies make sense right now?
Yeah, Nathan, that's as you pointed out earlier, certainly we've had an increase in correlation in terms of global markets this year, right? The S&P is down 20%. Investment grade bonds, which is supposed to be your safe haven place to be in generating income, are down nearly 16%. But treasuries, now yielding north of 4% on the 2-year as of today, which hasn't happened in over a decade. So alternatives in general will minimize the volatility that is associated with moves in other asset classes, other publicly traded asset classes, and reduce the correlation of your portfolio's return as a result. This is done through capturing illiquidity premium within the marketplace. Specifically, if we look at private credit, we're able to drive terms with the borrowers that we're lending money to, and additionally utilize our senior secured nature in the capital structure to be the first on top in case anything goes wrong. So you minimize volatility by protecting on the downside first and foremost. And secondly, we are a floating rate asset class. So not many asset classes out there can say that they're floating rate. So as the short-term end of the curve has moved up from 25 basis points at the beginning of the year in the market that we're referenced to now north of 3.5%, our interest that we're earning on our portfolio of assets has also commiserated and moved up 3.25% just by the floating rate nature of that asset class. So again, it's minimizing volatility, minimizing correlation, and extracting a liquidity premium in markets that are not necessarily accessible to everybody.
Hey, quick, Nate, to jump in before we go to the other panelists. Steve, what does illiquidity premium mean for our guests?
Sure, that's a great question. So illiquidity premium is the premium that you're going to receive by not having a publicly traded security within your portfolio. So you're going to earn additional income in the case of a private credit or public credit instrument, because the liquidity of that asset is not as great as, say, the U.S. Treasury market or traditional equity markets, where you can press a button and all of a sudden you can trade a basket of stocks in a matter of nanoseconds. In our market, both private and public, negotiating trading is still occurring. There's a wide bid-ask spreads. Relationships matter. So you get compensated additional spread on a credit portfolio than you would in a U.S. Treasury bond portfolio, for example.
So you get more interest. If I'm an investor, you get more interest because I'm not as easily able to buy or sell a private bond.
That's correct.
Okay. Thank you.
Perfect. Augie, we'll pose the same question to you.
Yeah, I mean, I think I'd echo what Steve said, right? This alternative assets provide investors access to investments that are outside the scope of traditional markets, right? And more times than not are uncorrelated. And I think more importantly, in a world where broad markets seem to be more correlated than ever before, it makes sense to gain this sort of exposure to alternative asset class that can and do offer diversification and ultimately reduce overall portfolio risk. Typically, this has been an asset class that has been only available to institutional and high net worth investors. And, with companies like ours, right, it's giving retail investors broad-based access to this type of asset class. And I think therein lies the importance. Now, specifically with digital assets, with crypto, right, you're looking at $1 trillion that's been created in the past 13 years. It's a way to gain exposure to a technology that's being adopted at a feverish pace, right? These are assets such as Bitcoin that are disrupting the money and store of value market. And ultimately, it's a way to gain access to that asset class.
And Augie, just briefly, when you say digital assets, is that fair to say that's synonymous with cryptocurrency? Are those two words interchangeable? Okay.
Yes, it is. Crypto, digital assets. You can use
digital assets sounds better than crypto.
Sure.
Thank you.
Yes.
It does. And Christian, do you have any additional thoughts above and beyond what Steve and Augie have mentioned?
I do. And I think it's important to view these types of strategies within the context of today. And if you think about the average duration of a bear market going back the last 100 years of being about 20 months, with the average drawdown being almost 40%, we may only be halfway there or not even halfway there. So what that means is more pain may lie ahead. And investors need to look beyond these market-based types of strategies and market-based returns to more skill-based returns, as I like to call them, instead of alternatives. So investing with managers that are exploiting a certain phenomena that is sustainable, that have a culture of risk management, that preserve capital, and that will give you a differentiated return stream relative to what investors have expected previously. Certainly in an era of cheap money and risk assets moving higher as a result of massive intervention post-global financial crisis. So our view is that there will be continued pressure on rates and also persistent volatility. And that has to do with what something Jerome Powell said today was, we take very seriously this unwind of this $9 trillion balance sheet. And most investors are not aware of this and are not talking about this, but this has massive implications for risk assets and equities and bond prices. And so when you talk about private markets, it's really a way to achieve a return stream that's separate from these types of asset classes with volatility that's lower, that's additive from a diversification standpoint, and ultimately that are going to help investors achieve their goals and the outcomes that they hope for, whether they're close to retirement or have a long runway for that. But private equity and private credit and hedge strategies, these are all going to be very important aspects of a portfolio and an asset allocation indefinitely, because let's face it, it's been really easy in an era of cheap money when the Feds had our backs. They no longer have our backs, and they've made that explicitly clear, and their credibility is on the line. So investors need to be aware of this and can't fight the Fed, because that is the number one rule and the number one mantra here. If they're tightening, investors need to be cognizant of that and preparing accordingly.
Yeah, and we couldn't agree more from an investment committee standpoint. Here at Tower Point, we've been having these discussions, and I couldn't agree with that comment more. Christian, we're going to stay with you here. What is private equity for the investors that are on the call who may have heard of it in passing or not heard of it at all? What is private equity, and why should they consider it for their portfolio? I know we discussed some of the reasons just a couple of seconds ago, but help us understand what private equity is for those who don't know what it is.
Sure, it's a bit cryptic, and lots of people talk about it without really knowing what it means. There's different stages of private equity, and most everyone's familiar with what early stage or venture private equity is. That's the riskiest part of it, the highest sort of IRR. That's the kind of lottery ticket that you hope to achieve ultimately. But there's other aspects of private equity that are just as equally important or less risk. Growth equity is for established companies and capital investments made in growing companies that are already generating revenue and already positive and play further along in a company's life cycle. And then you have private equity buyouts occur when a mature public company is taken private and purchased by either a private equity firm or an existing management team. And this represents the largest sort of cohort of private equity and the largest portion of funds in the private equity space. And just for the sake of perspective, in terms of assets under management, private equity as a whole is equivalent to assets under management for private equity is equivalent to about 5% of the value of publicly traded stocks. So private market investments obviously require investors to lock up their money for longer time periods, but they, as a trade-off for that, receive a significant illiquidity premium. And that's why private equity investments over time have outperformed public equity and public stock market indexes with less volatility, because they don't price as frequently, and because these represent the investments in funds across multiple geographies, whether it's U.S., China, Asia in the aggregate, or Europe, across thousands of underlying portfolio companies. And so we are firm believers that you need to pick and choose your spots accordingly in private equity, and can't just take a broad sort of approach to the space. That being said, we're very constructive on certain segments of the broader asset class on a go-forward basis.
Hey, Christian, quick question. Why does giving up liquidity, for me as an investor, what I hear from you, what I've heard from Steve, that helps my return in some of these alternative investments? Why is that?
Yeah, I mean, I think we're in a world where people want to be daily liquid and want to have this quote unquote liquidity, but there are certain sacrifices that you make to do that. And you can't make long-term capital investments in funds, in businesses specifically, that are going to give you multiples that are 3 to 5 times your money by taking a daily liquid approach. It just is not possible. There's always trade-offs. You can't have the best of all possible worlds. And so that's really the trade-off that investors make when it comes to private equity. But fortunately, the good news is that no longer do investors have to be confined to a 7 to 10 year private equity drawdown style fund where they don't get their money back for 7 years. Now, through structures like interval funds or tender option funds, these are retail friendly structures that give the investors the ability to achieve these big illiquidity premiums, but they do get their liquidity, or can get liquidity, on a quarterly or semi-annual basis, which is lovely, quite frankly.
Yeah. So a few years ago, or 5 or 10 years ago, if I wanted to invest in private credit, private equity, hedge funds, what have you, I would have to give up 7 to 10 years. Now there are more traditional funds, if I'm hearing you correctly, that we can get exposure to those areas if we want in the portfolio. And if we want to sell, maybe not daily, but on a quarterly basis, we still have that ability now.
Yeah, all this innovation is being driven by the demand side and the investor side. And now the non-accredited client or the accredited client that's not a qualified purchaser client can invest like an institutional investor and achieve the same sort of, not only the better returns that institutional investors have gotten over the last 30 years relative to equities, but would they do that with less risk? And that's really, I think, the first order of the day and of utmost priority against a challenging macro backdrop that we have present day.
Given that's the case, that you do have these interval funds that's available now to a broader investing universe, you mentioned just a couple minutes ago that the private equity made up 5% of the overall market. Do you anticipate? I would assume you would anticipate that growing significantly with as the learning curve. Investors move their way up the learning curve of what these products are and how they're used and how they benefit them.
Yeah, that's correct. I mean, we view things from the lens of the advisor. We build these strategies from the lens of an allocator, because that's what we are, allocators of capital. And so we want to find the best risk-adjusted opportunities, meaning we want positive asymmetry. And to make that simple is we want to maximize return for as least risk as possible. And we will lean into those strategies that are calling for that sort of opportunity, or at least demanding capital, so we can press capital to where we feel there's a best opportunity set. So we're actually in the process of launching a private equity tender option fund that is a 40 Act vehicle for retail investors that will give exposure to really the across the spectrum of private equity, from growth, there's some early venture stage, to growth and buyout, across a handful, actually a dozen managers, and that's on tap for Q1 of next year, and we're very excited about that.
Excellent.
You know, Christian, I just want to add one thing, just kind of about the interval fund structures. They are very unique, and they allow retail investors to access both private equity, private credit. But the one thing they really do, and it kind of hit home on capturing illiquidity premium, you want, when the rest of the market is selling paper, it is a trader by trade. That's what I always like to see, is when everybody's panicked and selling either bank loans or equities, you want to have a structure that's there to capture that selling opportunity, because that selling opportunity may only come around occasionally. And so we manage an interval fund structure that's both private and public credit. And we've really used this year and the volatility that we experienced in the public side of the market to really put on some really nice long-term risk-adjusted positions, that have snapped back, obviously, as the markets have rallied, but we weren't a forced seller, and that's key. The broadly syndicated bank loan market, which is a $150 billion retail product overall, had about $20 billion of inflows through May. Since May 1st, we've seen almost all those flows come out of the market, and managers that manage daily liquidity funds are being forced to sell into the market, sometimes at prices that they don't really have any determination over, because they need the liquidity on that day. And you want to be able to access product that can capture those selling opportunities when they do exist.
Perfect. Thank you for the addition. Steve, we'll stick with you here. Talk to us a little bit about private credit and how it differs from private equity.
Sure. Well, as Christian mentioned, the private equity market has obviously seen a boom, in assets under management, and represents a large part of the market, over the last 15, 20 years. What we do on both private credit and public credit is finance those buyout opportunities. So typically, a private equity sponsor, may buy a company for $2 billion, let's just say, and they'll come to the bank loan market and finance $1 billion of that purchase price. So we're financing these private equity transactions on a public basis and on a private basis. So the broadly syndicate market, which is, if you'd like to say, is a cousin to the high yield bond market, is about a $1.5 trillion market overall. And in that market, you're seeing financings for companies such as a Burger King, Charter Communications, names that Caesars Entertainment, for example. You're seeing those names come to market that are being bought by private equity sponsors that need access to a specific amount of leverage to make their private equity investment work. On the private side, these are smaller companies. So you have both direct lending, where you're going in and financing a private sponsored buyout of a company that may have $100 million of revenue and say $25 million of EBITDA. and you're financing that directly as generally the sole underwriter of that credit. And so what you're able to do is negotiate terms, whether it be covenants in your loan documents, amortization payments to ensure that you're getting some of the cash flow that these companies are generating and using that to pay down your debt, and other structural tweaks that really enhance and protect you on the downside. Additionally, there is kind of in the middle between the broadly syndicate market and the direct lending market, there's what's called the club market. And these deals are generally placed into 5 to 10 different buy-side investors, generally financing companies that are kind of in between that, small mom and pop type firm to a large corporate that you would know the name of. And so what we do at First Eagle is we finance companies throughout their life cycle. So a company may, begin its life as just a dental practice servicer operating in Chicago, for example. But over time, that company is going to want to grow into other markets, maybe acquire businesses within other markets, and we can grow our lending with that company over time. And as that company gets bigger, they may be sold off to another private equity firm and cobble together some additional assets and continue to grow. So private credit really finances the private equity investments that Christian was speaking of.
And you can really be selective with the deals that you choose, and I mean that comes down to expertise in that particular market, and you guys do very well. You also incorporate, as you mentioned earlier, a floating rate or bank loan, into the fund that you use. Can you talk a little bit about the relative value between bank loans versus private credit, and which do you prefer at this point?
Sure, that's a great question. So if you wind back the clock to say 12/31 of last year, we were seeing private credit transactions come with 2 to 3 more % interest rate attached to those loans coming to market. So we were, lending at say 5% all in, but on a floating rate basis to a broadly syndicate borrower, we were lending at 7.5% to a private credit borrower. So we really saw that and we view 2% kind of premium is the historical right spot to be investing in private credit versus public credit. Since we've had a lot of volatility in the public markets, we have seen really pricing on the public side of the market really kind of expand quite substantially, whether it's new issue loans coming to market or whether it's the yield that you can buy in the secondary market on a daily basis. So our portfolio shift over the last 6 to 9 months has really shifted from private credit to public credit. And it's taken some time for the private credit market to really adjust to the volatility in the public markets. But finally, we're starting to see some of that pricing start to come through. So if we look at our pipeline out the next 3 to 6 months, private credit is starting to be more adequately priced vis-a-vis the public markets.
Perfect. Augie, we're gonna get you in here. Gotta get you off mute though. There you are. You are our cryptocurrency digital asset expert. So what in the world is going on in the cryptocurrency universe? From 2020 to today, we've seen Bitcoin rise from 6,500 to 60,000, fall to 31,000, rise to 65,000, and settle today around 18,500. So understanding the volatility we've seen, what is attractive about the digital asset crypto market from an investment standpoint, and why should investors embrace crypto rather than being fearful of it at this point, given the volatility?
Yeah, so I can address both those questions, but I think first let's probably start with why it's an attractive investment. Look, this is an opportunity to own an emerging asset class, which in my opinion will prove to be the most disruptive technology of our generation. We all know how incredibly impactful the internet was, right? This was the ability to transmit our words to someone else instantly and for free via email, right? AOL, everybody remembers that. It was the ability to connect friends, people online. That was the original internet, right? The connection of people. And so then we have the Internet of Things, or IoT, where my phone talks to my car, talks to my refrigerator, talks to my house. And now we have the Internet of Money, right? The ability to move money around the world as easily as we send a text, doing it as cheaply, as securely, as safely, as transparently. And this is huge for businesses all around the world, because ultimately, what are they trying to do? They're trying to figure out how to move faster, how to move safer, how to move cheaper. And it's what blockchain technology is all about. And what we've actually seen is that this continued adoption is a driving force behind the value of Bitcoin and a lot of these other cryptocurrencies and most other cryptocurrencies, right? We're currently seeing an adoption rate that's faster than the internet. The rate is soaring right now. On average, it's growing at a rate of about 113% per year. And as many of you know, I'm sure, typically technology has an S growth curve, right? With a slow beginning, an acceleration phase, and then a stabilization phase. And so what we actually think is that we are right at the cusp of this acceleration phase of cryptocurrency growth. And we've seen this in the form of companies like Walmart, like Chipotle, like Shopify, McDonald's, Starbucks, all starting to accept crypto as payments right now.
So did the Sacramento Kings.
So is the Sacramento Kings. I mean, it's starting to, we're seeing this adopted, from sovereign nations now at this point. And so what we've seen is that, look, at the end of the day, there are about 2 billion unbanked people on this planet, right? And what digital assets, with cryptocurrency, what Bitcoin gives them is an opportunity to get onto the world economic stage. And all they need is a weak internet signal to do so. And that's what blockchain technology, that's what cryptocurrency is all about. Now, more recently, we've seen a broad-based sell-off across all markets, with crypto really taking the brunt of this, right? But if you zoom out, this is still one of the best performing asset classes in the past decade plus. 9 of the past 11 years, it has been the best performing asset class. And let's still remember that this is an emerging technology in an emerging asset class. And it's still a risk asset, meaning that there can be a significant degree of price volatility, which we've seen, right? However, if you look at this from a risk return profile, given the 70% drawdown, this tends to look like a pretty attractive asset class to invest in right now, right? All-time highs were right around 68,000. We're down to about 18,000. What we think is we've probably passed the point of, is Bitcoin going to zero, right? June 18th was the market bottom. And since June 18th, we've seen some major players in traditional financial markets start to come out and say that they are now investing and utilizing crypto as an asset class, right? We have BlackRock partnering with Coinbase. There were rumors that Goldman was getting into some of the distressed debt situations with a lot of these big name crypto news. And we actually just partnered with Franklin Templeton. Right. So big names are getting in the space right now. They're actively investing. And ultimately, we think that this is an asset class that is here to stay when used appropriately, when used correctly within traditional portfolios.
Augie, I was sold when Larry David spoke about crypto on the Super Bowl. That was a great commercial.
There were quite a few crypto commercials in the Super Bowl.
Yeah, just a few. Yeah.
Since have been quite a few.
Well, as a regular investor, Augie, we've talked about private equity, talked about private credit or private bonds. Obviously crypto is completely different, right? And that's really what alternative investing means, right? Different, not traditional, not stocks, not bonds. Why, we understand crypto is still young, but it's been around since when did Bitcoin first come out?
It was a 2008 white paper, but 2009 is.
Yeah, so 13 years.
Yeah.
It's been volatile, probably will continue to be volatile to some degree, as a lot of things have been. But what would be the main reason, in your opinion, why normal, traditional, everyday investors should be adding crypto as we oftentimes at TowerPoint call it kind of a complementary, with salt and pepper of the portfolio, so to speak.
Yeah.
But why?
Yeah, I think it's a lot of reasons, right? If you had an opportunity to go back and invest directly in the internet in the 1990s, would you have done it? And obviously hindsight's 2020, and
Well,
right. But ultimately that's what we're seeing right now. And both Christian and Steve talked about monetary policy. Listen, Bitcoin is the hardest asset that's ever been invented in human history. Okay, we know it's monetary policy, we know it's issuance, we know it's got a cap supply. Okay, and so with everything that's come out with the Fed continuing to print money, right? All these bills that come out to continue to flush money into the system, and a number of other things. This is a way to have a decentralized investment, which will ultimately, we believe, become a store of value. Similar to gold. Think of it as digital gold.
well,
So-
and limited supply is very attractive as well, like you said.
Yeah.
So as this thing grows, Bitcoin and being one of the largest or the largest in that space, governments are going to want to get in and start to regulate it. What does that do to the asset class?
Yeah, it's a great question. Actually, we think that regulation is, we're welcome to it. I think the crypto space, generally speaking, is welcome to it, because ultimately all that does is further legitimizes it, right? Right now, they're still trying to figure it out. The SEC is still trying to figure it out. There have been a couple bills that have been introduced. One was the most recent was the Financial Innovation Act by Cynthia Loomis and Kristen Gillibrand. And so even prior to that, right, the Biden administration came out with the executive order, and I believe it was end of March of this year, which ultimately was a positive for the crypto space. What they want to know is basically the administration put together a task force, so to speak, where they wanted to understand the crypto markets more, right? What they wanted to do was they wanted to understand how it worked. They wanted to ultimately help with inclusion, right? The inclusion for the average investor to get in. They wanted to understand the volatility movements and how that all works. And they wanted to adopt this as an asset class and really be innovators in the space, right? And what you've seen is that a lot of these different states out here that have basically opened their arms to, the crypto world have created jobs, right? Industry has moved there. You look at states like Texas, you look at states like Florida, which is now Colorado actually just announced that they were going to accept Bitcoin as payment for taxes. And this is just, it happens slowly and then it's suddenly, right? And we're starting to see that pick up right now. And it started with the Biden executive order, several months ago.
Sounds good. Christian, I have one other question for you here, and then I think we had some questions come in on the chat. As you mentioned at the top, you're not private equity is that's part of what you do, but you also have background in other of these alternative asset classes, namely being hedge funds, private REITs, and co-investments within the fund that you manage. Which of those asset classes do you like in this environment, and why is that?
Yeah, it's forecasting the future is a difficult endeavor, but it's successful investing is about putting probabilities on your side. And our view is that in light of the backdrop here, and we view that inflation, we are in this great transition from low inflation and low interest rates to higher inflation, higher rates, and that's probably here to stay indefinitely. And investors need to be prepared for that. And so the best opportunities, in our view, are going to be aligned with real assets, whether they're private equity, real estate, private equity on the debt side, or I should say real estate on the debt side, infrastructure, timber, farmland, agriculture, these sorts of things that are going to give you a very distinct return stream. Our view is that it's going to give you a better risk to return profile going forward and potentially generate income like real estate has. And inflation historically during inflationary periods has outperformed inflation. Private real estate has. And so our view is that these are the areas that we want to be flexing up and leaning into with institutional quality operators that have proven track records whether they be JLL or CBRE or Nuveen or Oak Street triple net lease. These are all areas of the portfolio that we're very constructive on. That being said, on the co-investment side, and co-investments is a whole different conversation, but specific opportunities that are short duration, that are credit oriented, that are asset backed, as opposed to these unsecured positions within the capital stack of credit, traditional plain vanilla credit, but being aligned with managers that are going to give you a first lien senior secured position that ultimately are underwritten to bankruptcy scenarios. These are areas that we like because they're floating rate. They have a floor of LIBOR or SOFR. They will automatically reset with a rise in interest rates. And these are return profiles that we expect to be not just positive, but actually double digits on a go forward basis. So these sort of off the run, less liquid credit opportunities, we would much prefer taking these types of credit risks and betting on ourselves to underwrite good fundamental managers in the credit space, best in class operators, rather than taking a view on the direction of interest rates or how dramatic Fed policy will be and what that will mean in terms of interpretation of those specific moves across asset classes.
So Christian, are you
And
saying that the private credit is less affected than more traditional bonds by what's happening with the Fed and with interest rates moving up so quickly?
Yeah, absolutely. And I know my colleagues.
Which makes it attractive potentially to investors?
Yeah, we believe there are material premiums to be had in private credit markets as the banks have stepped back post global financial crisis, and you've got operators that have stepped forward and have a specific niche. We have been invested in these areas for the last decade and continue to be constructive on these opportunities on a go forward basis. Yes.
Christian, I'll just add kind of one of your other points. It's very important, obviously, as a credit investor. The best we can do is get our par dollars back and some current income along the way, right? And so we're focused on current income and principal repayment at the end of the day. Obviously, as a credit investors, we employ a very stringent bottoms up type analysis, but it's also important to look at things from a top down perspective. So as we're looking at our markets today, both public and private, we're really trying to focus on credits that have pricing power within their industries, especially with 8% inflation, right? So we're focused on credits in technology, for example, that have contracted revenue streams that are very predictable, that allow credits to generate significant free cash flow that can be used to repay our debt that we lent out. We're looking at service companies as well, companies that have the ability to pass those prices through, and are less exposed to supply chain risk, less exposed to input cost risk, less exposed to higher labor inflation in general. So it's very important to look at things from an industry level perspective. Over my 25 years, I've been through 3 pretty decent downturns in credit, and with the average default rate being about 3.5% historically over the last 3 decades, you can outperform that default rate in below investment grade credit by avoiding 1 or 2 key sectors that really suffer. So things that we're looking to be not invested in currently and underweight in a lot of instances are retail, for example, where inventory level builds have really increased, especially since the beginning of the year. And now those retailers have to flush that through at significantly discounted pricing, not having any pricing power within the market. Energy, for example, we're not here to lend money out to speculate on where the price of oil is going, right? We can underwrite to $80 oil, but if it goes to 50 for whatever unforeseen reason, the asset impairment that we would receive as a result of that is too high for us to take those risks on. So industry selection is a key component to not only our underwriting standards, but also our portfolio positioning.
So Steve, Christian, to some extent, Augie, it sounds to me, again, if I'm a everyday investor considering alternatives, private credit and private equity and crypto as well, it sounds like I'm putting a lot of faith, if I'm hearing things correctly, in the skill and ability of the manager of the fund and his or her team of experts or analysts. I guess I'm curious, as a prospective investor or someone who has clients who are considering this. I hear a lot about index funds and how low cost index funds are, and how they don't create as much drag and you get better gas mileage because the costs aren't as much. And I think most people understand that alternatives in general are kind of on the opposite end. Help us to understand why it's worth pursuing alternatives, understanding the higher costs, as opposed to more traditional products that are lower cost but may not give you as good a returns. I'm just curious, what your thoughts are.
I'm happy to offer my 2 cents on that, because
Please.
I've had this conversation many times over the last,
I'm sure,
I'd say 12, 13 years. The era of passive investments, I'm going to tell you right now that it's over. It's done, because that sort of investment approach, that low cost passive approach, maybe there's a place for it in the portfolio, but I would argue it should be less of a place right now in terms of a core, because ultimately going forward, the risks are just too great. And we may be in this another lost decade. We may be facing another lost decade for public markets. And so trying to save 20 or 30 basis points on an investment or a fund, I think is an effort in futility, or at least loses sight of the big picture in terms
kind
of
of penny wise, pound foolish.
It really is, because ultimately paying a little bit extra for skill, and that's what we're really talking about here, is skill-based strategies.
Right.
Because if you're positive right now, year to date, you're probably you're maybe very satisfied, because you're not trying to beat a benchmark, but you're just positive. You don't see red in your statement. And so going forward, I think the risk side of things is going to be much more important and much more in focus, because we've lost that. And why we've lost that is because we've gotten really spoiled with central banks and loose money being a huge tailwind and being the put in place indefinitely, that creates this sort of Pavlovian dog by the dip mentality, where the Fed's always going to have our backs. Well, they've made it clear that they don't have our backs anymore. That's done. That narrative is over, and their credibility again is on the line. And so this is
see what happened today, right?
That's right. So this makes a case for these strategies. And again, it is not too late to be reshaping and rethinking your asset allocation. The worst may not be here, and we may have a long way to go. And if you remember, I was born in 1974, which is in the throes of the bear market back then. And back then, I wasn't around to remember, but I did do some, obviously, I'm a student of history. And the market went down, I think, every day for 2 years. And just realize what that creates in terms of a psychological impact of losing money every single day and just wanting nothing to do with markets anymore, not wanting anything to do with investment. So I think you really have to look at the big picture, and again, think about probabilities and paying a little bit extra for performance and for risk-adjusted performance, which I think is really, really important. That I think the retail audience is, if you watch CNBC, it's all about performance and upside, but you have to think about the downside first and foremost, and how much are you prepared to lose for that upside, that return that you're looking to generate. So yeah, I mean, there's a lot to say on the subject. I'll shut up.
Bottom line is it worth it, right?
Yeah, it is. I mean, at the end of the day, when you read case studies on Point72, which was SAZ Capital, or Renaissance, or Bridgewater, or DE Shaw, who's up 25% this year, the whole knock on hedge funds being underperforming and expensive, they're worth their salt in these types of periods. And that's why we like a lot of these multi-strat platforms, because this is precisely the environment in which they thrive, when you have so much cross-asset volatility and when they run very neutral portfolios that are about security selection. And so this is the environment in which they shine, and we're happy to pay full fees and be price takers, even if we're paying, of an incentive fee of 30%. If we're generating 9%, 10% positive returns this year, who cares?
Yeah.
Who cares?
And there has been a lot of cross asset volatility, as you said, Christian.
All right. This is kind of just a general question to everybody and it kind of a good wrap up, but Christian pretty much nailed it on this, but I'll pose it to also Steve and Augie. Is now the right time to get into alternative assets? Is it too late? What additional thoughts do you have before we wrap this up?
Augie, I'll start now. I'll make it pretty quick. I mean, when we look at our market, we see a lot of opportunity out there, and it kind of hits on what Christian was saying. Credit selection, just like security selection, is the most important thing. So, if you're doing your fundamental, bottoms up approach to credit, making sure you're allocating correctly, you will have opportunities to buy some very cheap assets when a credit does not perform as according to plan. In industries maybe now that we don't look as favorable, but somewhere down the line we will. So if you look out 12 to 18 months, our market is down 1%. The broadly syndicated market, that is, direct lending market is down less than 50 basis points. That's a win when you look across other asset classes. And we're long only credit. We're not a hedge fund or what have you. But maybe it doesn't feel great, but it certainly, when you look at the screens every morning, it doesn't feel so bad. So creating that opportunity and to doing so in a product that is certainly going to benefit from higher interest rates. And it's our belief that interest rates are going to be higher and for a longer period of time. It's a great way to clip 6, 7, 8% type coupons, with minimal volatility.
Yeah. So, my final thought is that, I think the traditional 64, I think we all can agree the traditional 60-40 portfolio isn't what it used to be. It certainly isn't what it is, 20 years ago. It's not what it was 10 years. I don't even think it was, the same as what it was 5 years ago.
And you say 60-40, meaning 60% stocks, 40% bonds, traditional.
Correct. 60% equities, 40% bonds. I think that in a world where everything is moving towards digitization, smartphones, right? Smart refrigerators, smart cars, all of this, crypto is literally changing the framework of our business and economic structure. And, Christian mentioned it. I mean, we've seen unprecedented monetary policy. We've seen the continuation of QE, price inflation. 40% of the money supply has been printed in the past year. Cryptocurrency offers a way out of this. It Bitcoin specifically, with the capped supply, right? Decentralized nature of it all. It offers a chance to opt out of that traditional system and have exposure to something that is new, emerging, and reshaping the way that, I think a lot of businesses and a lot of people have been and will continue to think about things. And, I mentioned it before, we're right at the cusp, of full-blown adoption. And in my opinion, in our opinion, we're going to continue to see these companies roll out some sort of crypto exposure, crypto adoption, further and further.
Well, not to mention, Augie, too, I mean, the demographic of who's most comfortable and owning crypto tends to be millennials. And I'm sure you could speak to, the great wealth transfer over the next 5, 10, 15 years. With candor, as baby boomers pass away, where's that money going to? Are to people who, certainly feel more comfortable owning and adopting crypto. So, I think in a very macro sense, your points are well taken.
Yeah, I mean, it's the biggest wealth transfer that's going to occur in history, right? Over the next, 24, 25 years, about $70 trillion is going to transfer hands from the boomers.
Trillion?
Trillion. $70 trillion is going to exchange hands from Gen X to Gen Z to, millennials. And I mean, you nailed it on the head, right? Gen X, Gen Z, millennials, they've also shown an appetite to have some exposure to digital assets, to cryptocurrency, and they have a little bit more risk, right? And so that all sort of adds into the adoption trend that's happening with all this. Now take that into consideration, and what do we see with, I mean, look back at credit cards, right? Do you know when the first credit card came around?
Early 70s?
1920. 1920. And then we had the Diners Club card in 1950, but it really didn't actually take any sort of effect, any adoption until 1980s when MasterCard and Visa came on the scene. And then, now what do we have, right? We have this, magnetic strips, and then we had the chips that you insert. And now we have, with your phone, you can just tap it on things. And, it's all sort of moving into this level of efficiencies. And this is just the next step. And typically these younger generations are on the forefront of that.
Yeah, when I think that can also be true from a private credit and a private equity standpoint. Individuals who are 25, 35, 45 years old, younger, generally speaking, are a lot more educated and knowledgeable about these alternative investment areas, are becoming more knowledgeable than perhaps their parents ever were. And not only was that knowledge base, not there 30 years ago, 40 years ago, but certainly, Christian and Stephen, to your point, obviously just the availability now, what we call the democratization of a lot of these alternative investments, certainly private credit and private equity being at the top of the list, just having more accessibility, creates more demand. So I think that's an important point as well.
Well, perfect. I know we're bumping up against our hour mark here, so I think we'll wrap it up there. If we missed any questions from those in the audience, be sure to submit those to us, and we'll make sure we get an answer back to you. But to our panelists, thank you very much. This has been very informative, and we appreciate your time this evening. And Joe, I'm going to send it back to you for a couple closing comments.
Yeah, no, appreciate it, everyone. It's been very useful, very informative. It's a bit overwhelming at all the information, but our intent here at TowerPoint, obviously, and in putting together events and a forum like this, is really just to educate our clients, our colleagues, our friends on all the different opportunities that are out there. Obviously, it's an extremely dynamic environment that we're in. For better or for worse, our favorite word here lately at TowerPoint has been unsettled. Not that we're happy about using it, but we think it does a great job of encapsulating, kind of the environment that we're in. And so to have the support and to have the resources as a fully independent firm to be able to leverage an Eaglebrook and to be able to leverage a First Eagle and a First Trust. And, obviously the brain power that what we're talking about here is fantastic. So, without everyone that we work with, without our clients, without our colleagues, obviously the people like the people that are on this call tonight, you're our lifeblood. So, we thank everyone that participated in the call. As Warren Buffett said, we need to think about being fearful when others are greedy. And certainly right now it's kind of the opposite. But Warren also said, think about being a bit greedy when others are fearful. And there is a certain degree of fear in the markets right now. And looking at alternatives is one way not only to better diversify a portfolio, but also potentially to take advantage of these opportunities. So if anyone has follow-up questions, certainly feel free, call us, email us, we will promptly reply. If you're interested in learning more about how TowerPoint Wealth as a fiduciary and as a fully independent firm, how we help our clients both build and protect their net worth, I encourage everyone to reach out by phone, email, social media, or our website. So thank everyone again, and have a wonderful evening.